Have you ever looked at a stock price and just thought, how? I mean, how does the entire world decide that one single company is worth trillions of dollars? What is the giant machine humming away behind those numbers on the screen? Well, today, we're going to pull back that curtain and see exactly how it all really works. And just to get a sense of the scale we're talking about, let's just take one company, the tech giant NVIDIA. At one point, its market cap, that's the total value of all its shares out there, hit an absolutely staggering $4.4 trillion. That is trillion with a T. It's a number that's almost impossible to really wrap your head around. And that brings us to the big question, right? When you see a price tag that enormous, how can anyone possibly know if it's the right price? Is it based on hard facts, a collective gut feeling, or something else entirely? To figure that out, we first have to understand the system that comes up with these prices in the first place.
So let's start with the fundamentals. We're going to take a look inside the market's big machine, see what it is, who's pulling the levers, and how the whole thing is put together.
You know, at its heart, a financial market isn't really a physical place anymore. It's a network. It's made up of every single person and system that has a hand in setting the price of something, like a company's stock. Honestly, you can think of it as this massive global conversation where the only thing being discussed is, what is this thing worth? So who's actually in this conversation? Well, first, you've got the participants. These are the investors and traders, the ones actually hitting buy and sell. Then you have the commentators, like equity analysts, who spend their days researching companies and then telling everyone else what they think. And finally, you've got the facilitators, the stock exchanges and the big investment banks that, build the whole playground for everyone else to play in. And this shows a really key distinction. The market machine has two main parts. Over on the left, you've got the primary market. This is where a company creates brand new shares to sell for the very first time, usually because they need to raise cash. But the market you hear about on the news every day? Oh yeah, that's the secondary market on the right. That's where all those existing shares just get traded back and forth between investors all day long.
Okay, so now we know what the market is. Let's get back to our huge question. How does this machine decide on a price? And can we actually trust that price to be right?
On the most fundamental level, it really just boils down to supply and demand. If more people want to buy a stock than sell it, the price has to go up. And if more people are trying to sell than buy, well, the price goes down. Every single trade is like a tiny agreement between a buyer and a seller who, just moments before, had different opinions on what that stock was truly worth. So how do people even form those opinions? Well, in finance theory, there's this big idea called intrinsic value. It's supposed to be the true worth of a company based on all the cash it's expected to make, forever into the future. But here's the catch. Who can actually predict the future? Right, nobody. And that means intrinsic value is never some hard, concrete number. It's always an estimate, an educated guess, which of course makes it totally subjective.
And this leads us to a really fascinating problem. If every single investor has their own slightly different subjective opinion on what a stock is worth, how on earth does the final market price become something we can trust? How does this giant mess of opinions somehow become intelligent?
To answer that, we need to dive into one of the most important and debated ideas in all of modern finance. It's a theory that actually tries to measure just how smart the market really is.
And here it is, the efficient market hypothesis, or EMH for short. Put simply, it proposes that the stock market is like a giant, super fast information processing machine. The theory basically says that at any given moment, a stock's current price already reflects all the known information out there about it.
Now, the theory actually comes in 3 different flavors, each one a little more intense than the last. First up is the weak form. It just says you can't beat the market by looking at past price charts. Next is the semi-strong form, which goes further and says prices reflect all public information, news, reports, everything. And finally, you have the strong form. This is the most extreme view, suggesting prices reflect everything, even secret, private inside information.
So the million-dollar question is, which one is true? Well, after decades and decades of research, the general consensus is right here on the screen. It turns out that major markets, think New York, London, are pretty darn close to being semi-strong efficient. And this right here is the big aha moment.
Okay, so what does semi-strong actually mean for us in the real world? Well, it means the market price is constantly and very quickly absorbing all the public stuff you see here on the left, financial results, news about the economy, analyst reports, you name it.
But, and this is so important, it does not know the things on the right. It doesn't know secret insider information, and of course it doesn't know the future because nobody does. So because the market is only close to efficient, not perfect, that means there are little cracks in the system. And it's in those cracks where professional analysts go hunting for hidden value.
Right, because markets are only semi-strong efficient. It means prices are mostly fair, but they're not always perfect. And that tiny little gap between mostly and always, well, that's where financial analysts live and breathe. Their entire job is to use different tools to hunt for stocks that the collective market might have gotten just a little bit wrong.
And one of the most common tools they use for this hunt is the price-to-earnings ratio, or the PE ratio. It's a pretty simple way to see how expensive a stock is compared to its profits. So for example, take a look at Cheapy PLC. Its PE is 10, but the average for the whole market is 15. For an analyst, seeing that lower number might be a little green flag that, hey, maybe this stock is a bit undervalued, a potential bargain.
And on the flip side, you've got Pricey PLC. Its PE is way up at 20, well above that market average of 15. That could be a signal that the stock is overvalued. It doesn't mean it's a bad company, not at all. It just might mean that its stock price has gotten a little ahead of its actual earnings power.
So we've gone through all of this theory. What are the big takeaways? Why does any of this actually matter to you?
All right, let's pull this all together. What are the key things to remember? First, a stock price isn't some fact written in stone. It is the market's collective best guess about a company's future. Second, that market is incredibly good and incredibly fast at absorbing all public news. Third, because it's so efficient, stock prices are mostly fair, but they're not perfect. And finally, that little bit of imperfection is what gives analysts a job, hunting for those potential bargains using tools like the PE ratio.
And this all leaves us with one last, massive question that people have been arguing about for decades. If a stock's price already reflects everything that we all collectively know, then what does it take to actually beat the market consistently? Is it about having some incredible, rare skill, or is it really just about getting lucky? That is the billion-dollar question that sits right at the very heart of investing.